What's up, guys? It's Rey-Jay back with another video. And in this one, I want to break down what's happening with SPY, Tesla, and the overall markets. I'm also going to break down why I believe that the market's going to be looking for an interesting shift going into next year. And something very ironic could be coming, especially as we do an analysis of the Fed. So I'm going to go over some very important things the Fed has done and how it's been affecting the markets. But just note that I am not a financial planner, so make sure you take nothing I say as financial advice. And also, if you guys can, please check out my Moomoo link. If you deposit $100, you're guaranteed 5 free stocks. If you deposit $1,000, you're guaranteed 15 in total, not to mention an 8.1% APY on uninvested cash. The offer ends very soon in just a couple of weeks. Anyways, now let's talk about the market. So when it comes to the way the market is moving, I just wanted to call this out right over here. We're going to go back to about the 2000s area, all the way down to like 1999, and talk about the dot-com bubbles. So a lot of people believe that when the market sees a Fed cut, we get a stock market crash. But that's not always the case, as it depends on different factors. I do believe there is going to be a correction coming next year, but it's not going to be that significant. It's not going to be like what we saw in 2008 or 2001. It's going to be more like a short dip followed by a lot of rips afterwards because of these different factors. I want to break down exactly why that is. So I was looking at the Fed fund futures rates, which basically tells us what the Fed's policies are looking like, if they're more restrictive or not, because this has a big ripple effect on the entire economy. If you go back to 1999, okay, this is over 20 years ago, the Fed started raising rates in 1999, okay? And the stock market was just pushing. And then as things started breaking, the Fed starts cutting. The Fed gave us their first cut in late 2000. Late 2000, we got that cut all the way over here. So we got this cut right over here in late 2000, and then that led to rates basically easing for quite some time as the Fed just continued to do this. But the reason why the Fed did that is because things in the economy start breaking. That's what incentivized them to make the moves that they had to make. So the economy slowing down is what fueled the market sell off. And it wasn't necessarily because they cut. It's not the cuts. Correlation does not mean causation. It has more to do with the economic turmoil that was going on during the time, during the dot-com bubble. So the markets saw this big multi-year corrective phase, which just continuing to tank. And that happened after our first cut. The market tanked before the first cut came. The cut came as a result of our economy taking a hit. And then they maintained a neutral stance right here in 2003. They kept rates low. The market starts to recover. Economy is recovering nicely. And then in 2004, the Fed has to start raising rates again for many years. So the Fed starts raising rates. The market kind of rallies with inflation, with these numbers going up. And then the Fed gives us that cut in 2007. Why did they do that in 2007? Because things started breaking. This was right before 2008 started. They had to cut rates. That's going to actually see it right over here. So like we had 2008 right over here. In 2007, they started cutting rates. And then that took us into the housing crisis that ended up happening because of the different factors that led to mortgage-backed securities being just absolutely overloaded and different banks being over-leveraged in them. So that had a very, very substantial effect once we ended up seeing those securities not necessarily working out, right? Because you were giving out these loans to people that weren't qualified, and then millions of Americans started to just default on their debt. So that had a very, very bad effect on the banks that were over leveraged, and it caused a lot of absolutely insane turmoil, just hurting their assets and whatever backed up their assets as well. So very, very crazy stuff, guys. A lot of crime happened back then. I'm not going to go over the full details, but that led to this big sell-off, right? And people always make that correlation that, oh, well, the Fed cuts, that means the market crashes. The Fed cuts, the market crashes, right? It's very easy to think that. But you have to remember, the market's not that simple, because the market is dictated by these institutions, these market makers that adjust the algorithms based off what benefits them. They know what you're doing. They know that you're buying calls, you're buying puts. They know. They know everything that we're doing, guys. They have control over it. And when they know what we're doing, they're not going to make it easy for us. That's why it's so difficult to day trade, because the market's always making these adjustments. There's so many ifs and buts and whens. It's absolutely insane. So after that, after the Fed cuts and after the amount of turmoil we got in the stock market crash of 2008 going into like 2009, the Fed had been cutting rates very aggressively. And then our economic recovery phase came because they kept rates very low for almost a decade, but besides this one exception, which happened involving Jerome Powell later on. But that's why the market had this massive run, okay? Because the economy was recovering and we were on a huge, one of the biggest bull rallies we had ever seen. We saw SPY go from basically the 70s all the way up to about the 200s, more than tripling in just a couple of years, right? Within 6-7 years. All right. So then what happened was near the end of 2015, we had a period where the Fed started to raise rates again. This was actually around the end of 2015 is when it started, very close to 2016. Essentially, it started raising rates again. Market gets an initial sell-off, and then it starts this uptrend despite the fact that rates are going up. We get another sell-off, so people think there's going to be a crash, this and that, only to make a full recovery. And then the Fed ends up cutting rates right over here. So rates get a cut. Amidst the rate cuts, what happened was we actually continued to rally. Then the pandemic happened, and that actually took us into a temporary recessionary phase. Unemployment spiked, and we saw our economy slow down to the point where technically, I mean, many people don't count this as a recession, but it was very similar to a recession because our economy took a massive, massive hit when that happened. This is what forged stimulus. So that's why we got this, what people refer to as the pandemic crash. We got this crash not because rates were cut, but because of the turmoil that happened at the time, how our economy was affected by the lockdowns, right? That's what caused the sell-off. It's not the fact that the Fed was cutting. So we sold off like crazy, only to make a V-shaped recovery because the US government was just printing loads of money. Inflation started to go up. That it wasn't really showing until a little bit later on. And then the market was pushing with inflation. It was also pushing with the amount of stimulus that was once again getting pumped into the economy. So stimulus pumped us back up. We made this full recovery. And then what happened is the Fed starts raising rates again. We actually saw the market crash. It did crash in 2022, technically, because SPY went from 480, started dipping, made a nice recovery, and it dumped all the way down quickly to about the 350s. So that is, by definition, we reached crash territory. And then we started to make this recovery phase heading into 2024. We started this massive pump. And since then, we've been just continuing to pump because earnings did not take a big hit. Because Jerome Powell keeps saying the economy is good, everything's fine. And because the inflationary data has been decent, as data is showing that inflation is going down. Now, do I trust every piece of data? No, I don't, guys. I don't trust every data. I think data is very, very biased. But just going based off the data alone, it makes a lot of sense. So we can see what's been going on. We're actually seeing progress being made, and the market's just continuing this nice little bull run. So this takes us now to today. The Fed has been cutting rates, okay? You guys can see right here, the Fed fund futures was going up. The federal funds rate, excuse me. That's it was going up for all these years. The Fed kind of like paused for some time, and now they're just barely starting the cut phase. So many people think like 2008, back in 2008, we got that crash. Back in 2001, the same thing happened. So are we about to see a crash? The answer is no. I don't think we're going to see a crash like that as of right now. But I do believe there's going to be a correction. I want to make a very, very important distinction between them. I think there's going to be a correction, but not a big crash. And the reason for that is because of manipulation. I believe that the market priced in a lot of this way back here when the Fed already was raising rates. They priced in a lot of the turmoil that was coming. And that's why we saw this nice little recovery phase already priced in the rate hikes. So now what about a recession? Is that priced in? Not necessarily. It's not really priced in. But I do want to say that if we do enter a recession, they're not going to keep the market down forever or crash it for an entire year. They can't do that. It's not going to go on for like 6 months, 3 months. It's going to be a short-term crash, a short-term corrective phase. It's not a crash, guys, just like more of a corrective phase. It's going to be short-term. And I say that because of many different factors, including the options chain. So what's happening is everyone is expecting a crash. Everyone keeps shorting the market. Look at the data. If you look at the put to call option ratios, the majority of people had puts. If you look at like Friday, we had 868,000 puts of these basically expiring. And we had a little bit over 400,000 calls expiring at 2.04 put to call ratio, 2 shorts for every long. That's why the market keeps squeezing on these Fridays. Look at the next few months. The same thing is going on heading into next year. People keep unloading up on shorts again, shorting, expecting the market to tank. Into next year, we're seeing something very similar developing, but it's not as aggressive. So this could shift as we get later on into like early next year. But for now, I'm just trying to say the end of the year is going to likely be bullish because of that. And also because earnings are not as bad as what many people were expecting. Because earnings were okay, because Powell keeps on pumping, the fact that, the economy is doing well, we're going to avoid a recession, the market continues to push on the soft landing narrative, and I think that's going to continue till the end of the year. However, what I presume is going to happen is, and I made another video about this, regardless of who's president, because of the fact that yields have been going up, we'll have to see how well yields hold up or not. We still have a lot of gaps to fill. And I do believe that there's going to be recessionary fears that still emerge, especially as we're seeing our yields invert. So especially the 10-year treasury yield, that is basically inverting. And with all these yields inverting, I just want to make it very, very clear that it's a very, very important recessionary indicator. There might be a recession coming early next year. And what's going to happen is if we do get a recession, the market's going to tank, but it's going to be fast, super fast. Right? It's going to be lightning fast, and then we're going to make a full recovery. Okay? Typically, when the recession's announced, we're already starting to recover because it's very, very delayed data. But just like this, I think we're going to see something very similar to what we saw over the last couple of months. We're going to maintain an uptrend in the markets most likely, but there's going to be those phases where we actually tank 20 points. We could tank even like 50 points on some occasions, and it could go on for like a month or two before the market makes a full recovery again. I think that's what's going to happen next year. We're going to see short periods of dumping and then longer periods of running. And they're going to continue to squeeze the market because of the fact that everyone's shorting it and because of the fact that earnings are now holding up well. Earnings have been quite decent so far. If you look at Tesla's earnings, they did well. We're still waiting on like NVIDIA and many others, but for the most part, earnings were quite decent. So I presume that earnings are going to continue to be decent. The market will continue to rally. And could we see a slight slowdown during a recession? Maybe, but I don't think it's going to be that bad. And I think that the market's going to make a full recovery. I think that the market's very optimistic with Trump, being president and also like the team that he's forging. And I think that that's going to be a big catalyst to help the market continue to rally the way it's going to be, because it's very forward looking and it's looking at the shift in future policies that could even like improve a lot of situations. Not to say everything's perfect. There's going to be like bad policies too. Good and bad policies come from every president, guys, in my personal opinion. Every single president has done, good and bad things. So that's the way the market kind of sees it. It's fueling on this soft landing narrative. It's going to continue to rally to the end of the year. Might be a small little dip on Monday because of Veterans Day, as there's not going to be as much volume, but we're going to continue this rally. And then I think that with the way the market's moving, with the way it's holding up with these earnings, there's going to be a correction next year, maybe as we get a couple of months into the year, like by February, March, around that period. It depends on different factors. There's going to be a corrective phase, and then it's not going to be that long. It's going to last a month or two. People are going to panic, think the stock market's crashing, the economy is going to collapse. That's what everyone's going to be thinking. And then the same cycle continues. We're going to continue to squeeze and squeeze and squeeze and squeeze and run and run and run and run. And we're going to continue to break all-time highs over and over again. That's what I believe is going to likely happen. I think the market's going to quickly price things in, and the market will continue to rally to new all-time highs. If I were to take a guess, I would say that, as crazy as this sounds, we could hit the mid 600s by next year. I think that we're going to continue this uptrend. It's going to blow everyone away. And there's going to be a lot of dip buying opportunities. The market's going to see these dumps again, but then it's going to continue to rally even harder. I think that Tesla is going to surpass $400 soon, maybe by early next year. It's not going to go straight up to 400. It's going to like push, come down a little bit, and then continue to pump because of the robo-taxi, because of all the hype that's out there, because of all this talk involving different shifts, and also because of what we're seeing, at least for Elon Musk being involved in Trump's campaign, and the list goes on. So we should continue to rally. We should pump, dip, and then eventually make our way into the 400s going into next year. I expect that for Tesla pretty easily. QQQ, it's going to continue to rally. It's going to rally very, very hard. There's going to be a corrective phase coming, so don't be overly bullish. We're going to eventually come down to fill these gaps. So it could push a little bit higher into early next year. Then we could see that corrective phase to fill some of these gaps. Even if we do return into like the 400s, it's going to eventually come back down to like the 490s, if not lower than that. But then we're going to continue to rally as next year progresses, and we will be breaking all-time highs again and make our way back up to the mid 550s could be coming as well for the NASDAQ or the QQQ. That's what I think is going to come. I maintain my bullish stance. Will there be a corrective phase because of a recession? Yes, I will. I'm saying that, but I don't think it's going to last forever. It's just going to be very short. So just keep that in mind. That's what my view is right now. Could my view change if there's a new pandemic or something else happens? Yes. But as of right now, we're on the trajectory to continue to rally thanks to Trump's presidency and many factors like that. That's my view. I think we will be breaking all-time highs next year. There will be corrections here and there, and that's what I think is going to likely pan out. All right? So you could call me crazy, think I'm wrong, this and that. But if you were some kind of permeable, you would have been wrong some instances as we got these little dips. But for the most part, the market just continues to rally like there's no tomorrow. The market will continue this rally most likely. So will Tesla, so will the QQQ, so will many tickers out there. There will be corrections here and there, but we will continue to rally for the most part. I hold this view. You guys could look at this video next year in like many months and a year from now. Look at this video and you will see that I will most likely be correct. So just keep that in mind, guys. And I thank you all for listening. Please have a great day and peace out.